literally a couple of minutes ago. Well, if you feel you're suffering whiplash from wild market swings these days, you may be interested in some stock picks from Jeff Reeves, editor he's editor at InvestorPlace.com, and he's also a MarketWatch columnist. Jeff, people are nervous out there. You recently wrote an article in which you focused on 5 stocks that generate both return and a little bit of peace of mind for investors. What was the common thread weaving through all 5?
Well, I kind of feel in an environment like this, people should stick with safe haven stocks, kind of low beta, low wiggle companies that are going to stay stable through the long term. Those typically are big consumer brands, companies that are cash rich, companies that have enough revenue to pay dividends and keep afloat. So I think investors should kind of steer towards those investments in this environment. You know,
do you look at how those stocks are valued relative to the rest of the market as well? Because your first stock that you like is McDonald's, just hitting an all-time high here recently. So even though you're advising people, look, this is the perfect kind of a stock, nice yield, stable, global revenue streams, but maybe wait for a little bit of a pullback?
Yeah, exactly. I mean, if you look at McDonald's share price, it's been nowhere to go but up for the past several years. Since Skinner took over in 2004, it's tripled. It's doubled since 2007. So there is kind of a fear that McDonald's is kind of getting the top. The PE is pretty high right now. I think it's above 15. But the bottom line is this company knows how to protect its balance sheet. Even though revenues have only grown by about 3% annually for the past couple years, profits are growing at 14% annually. And that's, it's got a 3% dividend on top of that. It knows how to make sure it's making more money, even if revenues aren't off the charts. Last week we saw a little bit of a hit for McDonald's because global same-store sales didn't really impress Wall Street as much, but it's the 100th consecutive month of same-store sales growth. They were up 3.5%. So, if you're looking for growth, there aren't a lot of alternatives right now, and I think even if you don't hit expectations, there's still a lot to be said for McDonald's right now.
All right, great American company. Hershey is another one that you like. Why do you like Hershey?
Well, Hershey's a sweet stock for your portfolio because in this kind of environment, people can't go to Aruba, they can't go to Europe on vacation, so they kind of find small comforts. Chocolate's a perfect example. Hershey's has actually seen 2 consecutive quarterly earnings reports that have been very impressive. They've raised guidance on the year actually because unlike other packaged food companies, they had a price increase that has really helped them keep margins pretty high even as commodity costs go up. So Hershey is up almost 20% so far year to date. Again, you might be kind of buying the top. If you wait for a pullback, I do think Hershey is going to be a good pick for you for the long term.
The sweet stock. I like that, Jeff. Hey, let's look at one of these pharmacy names because Big Pharma is always a safety play. Everyone says, look, get in there. They're going to give you a good yield. They're not going to move a whole lot up or down. But how do you pick one out of the bunch because they all seem to be in very similar boats? You like Bristol Myers.
Yeah, I mean, that's a great question. Big Pharma, they all have really good yields. They're all typically bigger than 4%, which is a great dividend. Even if stocks flatline, you get a 4% return on your investment. But the reason I like Bristol Myers above some of its peers is because since 2007, when some big pharma stocks flopped from peak valuations, Pfizer, Merck, they're down 30 to 40%. Bristol Myers is flat. The market is down 15% since 2007 at the same time. So, while it's great to have a stock that's going to deliver 20, 30% gains a year, there's a lot to be said for a company that's going to hang tough in a tough environment. I think Bristol Myers is that stock. There's been some really good news recently from the drug pipeline. As you know, patent expirations weighing on a lot of these companies. Bristol Myers got a great report. They could have the next big stroke blood thinner medication that's out there. It could be a blockbuster. They have a lot of niche plays, too, which are very small patient pools, but very high-cost drugs. Melanoma, kidney transplant medications, which can really pay off for them. So big dividend, good drug pipeline. I like Bristol Myers right now in pharma.
All right, Jeff, you also like Colgate-Palmolive, but I want to get to your last stock in the interest of time. And it's ironic or it's interesting because it's the most boring of all the 5 stocks, Con Ed. I mean, you talk about a grandparent stock that's been stuck in their portfolio for years, but you like it because it's safe. And there's no stock on earth that can give you an almost guaranteed dividend like Con Ed can.
Yeah, I mean, when you look at stocks, it's great to have a big consumer brand like McDonald's. Everyone knows McDonald's. Unless you pay your monthly bill to Con Ed, you probably don't even know who they are unless you live in the tri-state area around New York. But the thing about Consolidated Edison that is so attractive is that they have increased their dividend consecutively for 36 years straight. Maybe even 37 after the last report. I'd have to do the math. But they paid dividends since 1885. This is a dividend company that you can bank on. Besides the fact that, not to mince words, but it's basically a legalized monopoly here. They have no competition. They have really a cash-rich business with reliable revenue streams from their customer base that isn't going anywhere. So it's not going to burn down the house with like 50% annual returns. But if you want a good, solid dividend pick for the long term, Con Ed is definitely a good one to take a look at.
And also just recently hitting a 52-week high. That is the quintessential set it and forget it stock and reinvest those dividends, no question. Jeff Reeves,